Hi everyone, today we'll be presenting our risk management framework for nature and biodiversity risks, along with case studies of two banks, BNP Paribas in Europe and DBS Bank in Asia, to evaluate how well real institutions are managing these challenges.
Our proposed risk assessment framework, aligned with TNFD's LEAF model, systematically addresses nature and biodiversity risks. The first step is to identify physical, transition, and liability risk factors through advanced geospatial techniques. The next is to evaluate and assess these exposures. We integrate quantitative metrics and qualitative inputs into weighted average indicator scoring mechanisms to clearly define risk scenarios, probabilities, and severities. Leveraging stress testing methods, we quantify expected biodiversity-related losses across short, medium, and long-term horizons. This assessment sets the stage for preparation, informing effective monitoring, targeted risk mitigation, and compliance reporting strategies that we'll discuss next. And the last is about application of the two banks.
Nature-related risks fall into three main types: physical, transition, and liability risks. Physical risks, like deforestation and water scarcity, disrupt industries that depend on natural resources. Transition risks arise as new policies and market shifts make some assets less valuable. Liability risks come from lawsuits, reputational damage, and regulatory fines for unsustainable practices. These risks impact the financial sector in different ways. Deforestation, for example, increases credit and operational risks, leading to loan defaults. Water scarcity raises market and credit risks, hitting industries like textiles and food processing. Soil degradation drives up insurance risks, while regulatory changes and lawsuits create liability and reputational risks. Sectors like agriculture, mining, real estate, and banking are most exposed. Geographically, Southeast Asia faces deforestation, South America struggles with land degradation, and Africa deals with water shortages. Europe, meanwhile, is tightening financial regulations. These risks demand proactive financial strategies to reduce exposure and improve resilience.
And to evaluate biodiversity exposures, we utilize geospatial data to determine weighted risk indicators, including proximity to protected areas, threatened species counts, and habitat conversion rates to generate clear risk scores. We enrich our analysis by developing detailed scenarios ranging from proactive global climate action to insufficient policy responses, capturing varying degrees of ecological and financial impacts. To quantify this impact, we use stress testing techniques like dynamic variable-risk modeling and Monte Carlo simulations, resulting in calculations of expected loss under different risk scenarios. Altogether, this comprehensive approach strengthens our overall risk assessment and quantification.
On top of our risk assessment metrics and risk frameworks, we focus on four major nature risk categories which are monitored, being deforestation, water scarcity, biodiversity loss, and ecosystem degradation. Each of these categories has specific KRI and thresholds that, if breached, signal significant financial and operational risk to businesses. Starting with deforestation, the key indicator is the forest cover loss rate. A loss rate exceeding 5% annually triggers a red flag. This has been associated with disruptions in supply chains, particularly in timber, agriculture, and paper industries. Next, water scarcity is assessed using the WRI Aqueduct Water Stress Index. A score above 3 indicates high risk where water demand exceeds supply. This places pressure on water-reliant industries like agriculture and energy, driving up operational costs. Biodiversity loss is measured with our biodiversity risk score by using our dynamic VAR monitoring tool, which was shown and explained in the previous slide. And lastly, ecosystem degradation is tracked via the Ecosystem Health Index, where we employ a threshold of 15% decline, signaling ecosystem damage from land use changes or pollution. This threshold has been proven to reduce asset values, disrupt economic activity, and lower a company's creditworthiness. This monitoring framework would help institutions proactively identify and mitigate environmental risks that directly impact financial performance.
Our hybrid financial product designs are crafted to strategically address the inherent constraints of standalone instruments, which, despite individual strengths, often limits market access, product diversity, and optimal capital allocation. Models including stacking, stapling, and bundling leverage complementary advantages and mitigate single-tool limitations, effectively managing risk and aligning the investment with complex environmental and financial objectives. By supporting multifaceted environmental objectives, we amplify the efficacy and reach of each investment, maximizing the return on every dollar. Also, the framework supports allocation of capital to both direct conservation projects and also the transformative sustainable initiatives. Last but not least, diversifying across multiple environmental objectives allows for both broader market appeal and risk of dispersion, enhancing stability and potential returns. Moving forward with the management strategies, we recognize the critical role of blockchain technology in addressing the most significant barrier of aligning the financial portfolios with biodiversity goal, which is high transaction costs, including monitoring, verification, contract enforcement, and price discovery. The distributed monitoring network leverages a sophisticated array of technologies to monitor the ecological changes, providing real-time, accurate data for VAR calculation in risk assessment. The smart contract mechanisms facilitate automated, compliance-guaranteed transactions based on those specific biodiversity achievements, thereby aligning the financial rules with TNFD commitments. Finally, the model converts the biodiversity outcomes into tradable digital tokens with greater market access, enhancing the market transparency and facilitating investor engagement in conservation efforts.
We then designed a reporting and compliance framework that financial institutions can adopt to manage biodiversity risks more effectively. The core objective is to make nature-related risks both measurable and reportable, aligning impact on financial performance with impact on ecosystems. To achieve that, we propose standardizing what gets reported, using exposure and impact metrics such as portfolio water footprint and biodiversity loss tied to investments. We also recommend integrating biodiversity risk into financial stress testing, capturing short, medium, and long-term nature risk scenarios, such as ecosystem tipping points. Crucially, these disclosures should be embedded into quarterly and annual reports, with board-level oversight and third-party audits, such as those aligned with TNFD or CPD ratings. Finally, we've laid out a phased implementation strategy, from defining obligations to piloting reporting tools and aligning with EU regulations. This ensures the network is not only ambitious, but also practical and scalable across financial institutions. For our European case study, we analysed BNP Paribas, a bank widely recognised for its leadership in sustainable finance and biodiversity integration. They've embedded nature-related risk considerations into their decision-making using frameworks like TNFD and SFDR, and they've developed tools such as biodiversity scoring and ESG sector screening, particularly in agriculture and forestry. One of their biggest strengths is the use of AI and satellite data to monitor risks like deforestation alongside robust investor reporting. However, their biodiversity stress testing is still in its early stages, and biodiversity-related financial impacts are not yet fully quantified. Additionally, monitoring maintains concentrated in a few sectors, leaving potential blind spots, particularly in areas such as infrastructure and energy. Overall, BNP Paribas is ahead of most banks in this space, but still has work to do to reach best practice standards, especially around risk modelling, sectoral coverage, and real-time response tools.
DBS's approach to sustainability and biodiversity risk management is grounded in strong regulatory alignment, particularly with MAS guidelines. We assess project risks using tools like the Environmental and Social Risk Assessment and support innovation through initiatives like the SustainTech Accelerator. The reporting follows global standards and integrates environmental and social risk into financial decision-making. Strengths include comprehensive frameworks and strong regulatory alignment. However, limitations exist, such as the lack of forward-looking modeling, weak sector-specific risk pathways, and limited use of AI. While effective in structure, the frameworks don't fully capture emerging biodiversity risks. Improvements could include AI-driven tools, stress testing, and better client guidance on biodiversity impacts. Compared to best practices, DBS is well aligned with standards but needs to boost its predictive capabilities and tech integration.